Examples. So before we get into the real life examples, I just want to introduce to everyone our new LRK Tax CEWS 2.0 calculator. If anyone's used our first calculator, it's pretty similar to what we've done before. So we have a nice summary page, which basically mimics the information that CRA is looking for when you're applying. So they'll ask for the total number of eligible employees, the total eligible remuneration pay, the basic CEWS, CPP and EI premiums, as well as the 10% TEWS. So even though that particular program has not been extended, this particular calculator can be used to compute the CEWS subsidy under periods 1, 2, and 3. So the first 3 tabs are really what the applicant really needs to use to look out for. We've made our calculation pretty straightforward. I mean, I don't want to get too much into the details, but anything in yellow is an input cell. Anything that's not in yellow, you really don't have to do anything to. So when you first use this calculator, the first thing you want to do is pick the application period that you're applying for. So there's a total of 10 periods. We're going to pick, July 5th, the 5th period. And basically, once you've picked your period, then you just basically put down your monthly revenues. So you'll put down your current reference period revenues from March 2020 to December 2020, computed under the accrual method or the cash method. Likewise, you'll do it for 2019. And if you so choose to use your revenue decline comparison under the alternative method, you put in your January, February 2020 revenues. So as a quick test, suppose I have $500 of revenue in 2020 right now, and in July 2019, I had $1,000. Things will automatically start to pop up. Again, it's not yellow, so you don't have to worry about it, but it will show you that you're eligible because obviously I have a 50% decline. Furthermore, it'll basically take the current year's 50% decline and apply to the next period as something that you could consider using. Because as mentioned earlier, there was a deeming rule which allows you to use the preceding period's revenue decline as your own. So there's a lot of calculations, a lot of nuances that go into this. I don't want to get into too much detail into how all this stuff works, but because of the complexities and the legislation and the significance of getting these calculations wrong, there's a lot of thought and testing that went into this. So again, for the user, they only have to focus on the first 3 tabs. Once you fill the first 2 tabs, the second tab out, the third tab is really the salary. So let's assume we have one employee that it's not a non-arm's length, not on leave with pay. We were looking in July, so that's period 5. So suppose I have $500 per week for this employee. When you put this information in, you should be pretty much done. So you go to your summary page, you'll say total number of eligible employees is 1. Total eligible remuneration summarized 2,000. As you can see, 4 times 500 is 2,000. And you'll notice that the CEWS for this is 1,500. So even though we're in period 5, and we talked about this earlier, we have the base percentage is 60%. And the top-up percentage is 0 because it's not greater than 50. There is a safe harbor rule that we automatically baked in as well, where for period 5, if you're eligible to claim the CEWS under the original 75%, you would be able to get that. So in this particular case, because the old rules were more beneficial, our software automatically takes this into consideration. So again, our calculator is pretty powerful. It takes into all the scenarios automatically. The only thing that the users have to do, again, is to fill in the revenues, pick the right period, put in the salary, and that should be it. And I don't want to go into all the calculations that go behind it. For example, we'll have our base decline percentages computed. We'll have our top-up decline percentage computed as well separately. I mean, this is the package of documentation that we expect the government to ask when we'll be reviewing the applications in due time. So when we provide this, when we prepare these subsidies for our clients, we have all this documentation on hand because we know that the government's going to come knocking and ask them to just substantiate their claims. So we have every single possible calculation outlined, every single permutation kind of covered. So it is pretty involved, took a lot of hard work to come up with this, but just wanted to show you that this is the capability that we have to make sure everything is correct and accurate. Examples. So in our first video, we showed employers the top 10 things they needed to know about the new CEWS subsidy. In this particular video, we'll go over some examples that apply those principles in practice, as well as show how our calculator can come up with the subsidies based on these facts. So our first example deals with Cafe Inc. And how Cafe Inc. may qualify for the 85% wage subsidy. So they have 5 employees that made $1,000 a week. They were shut down and they're starting to reopen again. This is the fact pattern. So you'll see the revenues here. July 2020, 150,000. July 19, 500,000. And you'll see a revenue decline of 70% for this particular month. For the 3 months preceding July, April to June, their total revenues was 300,000 or $100,000 per month. And for the same 3 months in 2019, it was 1.5 million, or an average of $500,000 per month, for a revenue decline of 80%. So here is our calculator. You can see that the first thing we want to do is make sure that we pick the right period, which we have. I've done all this already to avoid, having you guys watch and you enter some numbers in a yellow box. So we make sure that we put in the proper period. Picked our drop down arrow, make sure it's here. Then essentially we just put in the revenues that basically fits your fact pattern. So as we said, these were the revenues for 2020, and these were the revenues in 2019. Once you're done that, go to your salary. You put in your 5 employees' name. Obviously, they're not called 1, 2, 3, 4, 5, but if you call your employees 1, 2, 3, 4, 5, feel free to put that as your description. But please make sure that you put in this information. Is the person arm's length, non-arm's length, and was the employee on leave without pay, with or with pay? So in our fact pattern, it's no for all. It was $1,000 each per week for all the employees. So I just basically copy pasted everything into these boxes. So once you've filled out all these boxes, then you should be pretty much good to go. And when we hit the summary tab, right, it'll automatically come up with 5 employees. I'll tell you for this particular period, there was $20,000 in remuneration paid, and that your subsidy is $17,000. So that's pretty much it. And now that we know it's $17,000 based on the calculator, let's do some rough high-level review to make sure that's correct. So I'm going to put this calculator out of the way and show you how we came up with the subsidy of $17,000. So the base wage subsidy is 60%. If you guys were paying attention, if you have a greater than 50% revenue decline, you get a 60% wage subsidy for the base. And obviously you do. So 60 times 20,000 is already 12,000. So we have to calculate next the top up wage subsidy. Again, I'm not going to repeat the formula, but these are the formula. This is the formula. It's the lesser of, so you won't ever cap 25%. So suffice to say, in this particular case, it is 25%, just because the decline is greater than 25% based on this formula. So essentially, our subsidy is pretty much the base subsidy of 60% plus 25% equals 85%. So 85% times 20,000 is 17,000. So that is how it's possible in a scenario to get an 85% wage subsidy. That is better than the original 75% wage subsidy. So example 2 deals with how the new CEWS can apply to those employers with less than 30% revenue decline. Under the old rules, this particular fact pattern, you wouldn't even be in discussion of getting a subsidy. But with the new CEWS, it kind of shows how this is in place. So suppose the employer is Orange Auto Service, again has 5 employees, make $1,000 per week. It seems like a very common fact pattern. Everyone gets paid $1,000 a week, nice round number. Here is the fact pattern. So here are the revenues. July 2020, 80,000. July 2019, 100,000. So there was a year-over-year decline of 20%, which is, under the old rules, less than 30%, you wouldn't be in the running for the subsidy. Also, for the 3 months prior to July, you have a combined 300,000, and for the same 3 months in 2019, combined 400,000 for a decline of 25%. So to show you how this works, I can quickly, even before showing the rest of the slide, that the subsidy should be 24%, because again, you remember the multiplier for the month of period 5 is 1.2 times the revenue percent decline. It is 1.2 times 20%, so that's 24%. And if your revenues for 3 months did not drop more than 50%, then you don't have to worry about it. So the top-up subsidy is 0. So your subsidy really is 24%. So let's just see if that's correct. So the base wage subsidy 24%, 1.2 times 20%. Top-up wage is lesser of blah blah blah, or it's 25%. So it's 0 or 25%. It's 0 because they didn't have greater than 50% decline. So indicated the combined CEWS is 24%. So in this particular case, you can get at least something if your revenue decline is not greater than 30%. So example 3, safe harbor rule for periods 5 and 6. This particular example illustrates that computing the CEWS subsidy isn't just about putting some numbers on a spreadsheet. Although our calculator does make it that easy, there is some analysis and some thought involved. So in this particular example, we'll continue on with our common example with 5 employees that make $1,000 per week, but instead of being restaurant or garage, it's gonna be for Prius Fine Arts. So Prius Fine Arts has revenues as follows. In July of 2020, she had 200,000. July of 2019, she had 300,000. So we have a 33% decline. For the 3-month top-up period that we are looking at, April to June, 750. For the same 3 months in 2019, $1 million, for a 25% decline. So again, without even going into the next text, you can quickly understand that the multiplier, if you remember, was 1.2 for period 5. 1.2 times your revenue decline percentage is your base subsidy percentage. And so when you take a calculator, 33 times 1.2, you look at 39.6%. And also for the top-up subsidy, you don't really need to look any further, because it's really meant for those businesses with a 50% decline or more. So in this particular case, you're not even at the 50%, so we don't get a top-up subsidy. So in that particular case, your CEWS should be 39.6% as your reimbursement rate. Again, this is computing it without the quote-unquote safe harbor rule under the normal rules. So again, 39.6, because the revenue decline of 33% times 1.2. Top-up wage subsidy is the lesser of this formula, which is 0, because you need to be above 50% to get into variable A. So the combined CEWS is 39.6 plus 0% is 39.6%, or rounded up 40%. 40% times 20,000 is $8,000. So that's your CEWS subsidies computed normally. But because there's something called a safe harbor rule, where it allows applicants to use the old CEWS legislation to get a 75% reimbursement when there's a 30% revenue decline, that particular rule would be useful in this particular case, because you can see that the revenue decline here has exceeded 30%. So under the old rules, 33% would be enough to get you a 75% reimbursement rate. And in this case, we would want to use the safe harbor, because again, for periods 5 and 6, there's a safe harbor concept where it allows you to borrow from the old legislation for those periods to compute CEWS under the old legislation. So in this particular case, it would make more sense to use the safe harbor rule to use to compute the CEWS subsidy under the old legislation, because you're getting 75%. Whereas if you don't do it, you're only getting 40%. So in this particular case, if you apply the safe harbor rule, you'll be getting $15,000 versus 8,000. So obviously 15 is better than 8. And it's a good illustration to show people that, again, there are some considerations and thought process that goes into these subsidies. It's not purely mechanical. So perfect example for that. So example 4, safe harbor in the prior reference period. This particular example further illustrates that the CEWS subsidy isn't just about putting some numbers into a spreadsheet. There's some planning and thought into it. So in this particular case, again, surprise, surprise, it's going to be 5 employees, $1,000 per week. This particular employer, Simple Subs, doesn't really look like a sub. I'm not sure, more like a sandwich. And I don't know what these little marks are, but in any case, not relevant, because the only thing we really want to show is this particular table. Again, the revenues per month, 80,000 2020, 100,000 July 2019 for a revenue decline of 20%. We'll have April to June 2020, the 3 months 250, for the same 3 months 2019 400. And to be more specific, in these particular months, June 2020 was 30,000, June 2019 was 50,000. So if we don't do anything, we don't consider the safe harbor rule, the base wage subsidy is 21%, because again, we're in period 5. The multiplier for period 5 is 1.2. Your revenue decline is 20%. So 1.2 times 20% is 24%. Top up wage subsidy, before even clicking on it and showing the DEX, you know it should be 0, because this is less than 50. Again, 37.5 minus 50 is negative 0%. So the combined CEWS is 24% for your wage. So again, it would be 4,800, 24% times 20,000. So if you use the safe harbor rule, it's pretty interesting, because the safe harbor rule in July requires you to have a revenue decline of 30%. On its own, the July months wouldn't qualify for the safe harbor rule, because it was only 20%. Because even under the old CEWS program, you needed a 30% decline. But in this particular case, there's a previous revenue decline concept that we can bring into play here. So in the month of June, there was the revenue decline of 40%. In this particular case, this 40% decline can now be transferred to July period 5. So in essence, the revenue decline for July could be 20% or could be 40% if you apply this previous revenue decline concept rule. And because July period 5 is one of the periods that allows you to have the safe harbor rule, that allows you to basically take advantage of the old rules, that means that July would qualify for a 75% wage subsidy, because in essence, it has a 40% revenue decline. So this particular bullet just summarizes that. Exact Simple Subs can use the 40% June revenue decline for July, and therefore when it inherits that 40%, it will automatically meet the 30% using the safe harbor rule to get the 75% wage subsidy. So consequently, with these two rules in interaction, the CEWS subsidy is now 15,000 compared to 4,800. So almost triple in this case. Now obviously this guy here sitting like a boss, thinking about his money, because all he had to do was apply a couple of concepts, and he literally almost tripled his money. So this example kind of further illustrates how powerful these rules are if you apply them not just in isolation but in tandem, because there are possible scenarios to allow you to multiply how much of a subsidy you can get. Okay, so there you have it. 4 real life examples on how these new CEWS subsidy rules work. I hope in particular the examples 3 and 4 emphasize that although CEWS requires a huge amount of computation and mechanical arithmetic, there are also other planning considerations that go into it to maximize your subsidy. If anyone needs help with calculating the subsidy, we're always here. You can check us out at www.lrktax.ca. We have a wealth of resources that you guys can check out to help you understand the subsidy and also help you compute the subsidy. So once again, thank you very much, and we'll see you next time.